morning. We're here to talk about the implications of the SVB collapse. But before we do that, let's talk about the general economic environment and how we got here. We've had a period of rising interest rates. The Fed has indicated today that we expect another couple of rounds. They've been followed by the central banks in the UK, Canada earlier this year, which got us into thinking about recession. And of course, recession gets everyone a little bit nervous. Money got tighter, money got more expensive. Then comes March, and Silicon Bank happens, and money gets absolutely terrified. So where are we now? Well, if we look at the scorecard, I can tell you that Inc. reported this week that global funding was down $22 billion in May. That's a 44% drop. Startup Genome reported that there's been a 60 to 80% contraction in Series A and B since 2021. 20% of those are down rounds. And this morning, Bloomberg reported that if you look at the broader deal market, it's down $1 trillion. So, sort of asks the question, where are we now? And now we have a couple of panelists who have money for you, Joe and Amber, and then if you get that money, then Don can run it for you. So let's talk about Silicon Valley Bank, what happened to it, how you reacted as a banking services provider.
Definitely. Hi, everyone. My name is Don Muir. I'm the CEO and founder of ARC. We're a digitally native banking and growth capital platform for startups. We went live today on Product Hunt in celebration of this panel here at Collision, so check us out if you have a minute. Look, ARC was on the front lines when the startup ecosystem experienced an unprecedented shock. With interest rates spiking and venture capital funding down 50% year over year, the last thing that founders and the venture community needed was a shock to the banking system. The week that SVB failed, ARC's inflows spiked 15x higher than the historical average since we launched our banking platform. And ARC was there with the ability to spin up FDIC-insured accounts in less than 10 minutes, helping safeguard cash and diversify cash across a network of offline financial institutions. And so the question in this panel is, well, what's next for the startup banking ecosystem? Well, as we saw in the consumer banking world in April with the partnership between Goldman Sachs and Apple, it's my view that the largest, most systemically important financial institutions will start partnering with tech companies such that founders can access a personalized, software-driven tech banking experience with the security of the largest balance sheets in the world. And to bring that to life, at ARC, we're partnered with BNY Mellon, have cash sweep programs with JP Morgan Chase, Wells Fargo, Goldman Sachs, and Citigroup, which provides a customized software-driven experience with the security that comes with banking with the largest banks in the world with trillions of dollars of assets. So it's my view that the next phase for tech banking won't necessarily lie with the community banks, but with the largest banks partnering with fintechs to deliver that customized, personalized banking experience that Silicon Valley has come to expect and deserves.
But does this, A, suggest that we're going to see more problems with the smaller banks? And traditionally, investors, startups have looked to these smaller banks to help them. I mean, SVB had a great reputation. So do I now have to go through JP Morgan?
SVB, FRB, PacWest, these were the bedrock of Silicon Valley for the last 4 decades. Some of the greatest, most durable tech brands were built on the backs of these banks. they serve a purpose, and that purpose is a customized banking experience for the tech community. I don't think it's the end for community banks. I can't predict what's going to happen more broadly across the community banking ecosystem. What I can predict and what I expect and what we're seeing, since we're growing another 2x, 3x month over month since SVB went down, is that big banks and small banks will continue to partner in a more meaningful way with tech companies to distribute their products across the tech ecosystem.
Okay, so let's turn to the investors. Tell us about how the world shifted or did not shift this year in the rising rate environment, and after we've had 3 banks go under this year.
Yeah, I guess I would just start by saying there's a level of recognition for the founders in our portfolios and the way they navigated the banking crisis with Silicon Valley Bank. In my portfolio, TR Ventures, and in many peers, the founders were the ones that leapt to action and drove with leadership through that crisis. And there were a lot of investors that had to step in with backup capital, and that was really spearheaded by the founders. And so, huge admiration for the founders. I think where we are now is we're in a bit of a bifurcated market. For some companies, it is tough to raise venture capital, but for other companies, there is still investment out there. And what I mean by that is for later stage companies that, it's a get-fit environment. If you do not have a path to profitability, if growth is decelerating, and you will have a tough time finding and raising capital. We're lucky enough, we're focused on Series A and early stage, but we also see a fair amount of late stage companies as well. And we talk to a lot of growth investors, and I think it's a pretty consistent point of view. But the bifurcation is that in the earlier stage, if you are building a company, particularly an AI-centric company, in a market where there is a known definable answer to insight or analytics or synthesis of information, particularly in B2B or variety of different enterprise verticals, there are plenty of investors that are investing at all layers of the technology stack, from foundational models to infrastructure to verticalized applications. So I really think it's a sort of a tale of a bifurcated market at this point.
Amber, what have you seen?
Yeah, well, hi, I'm Amber Atherton. I'm a partner at the early stage gaming fund Patron, but I was on the other side of the table. I took my startup through Y Combinator in 2018, and then we were acquired by Discord in 2020, which was a very risk-off environment. But when we were in the midst of the SVB crisis, I wanted to give our portfolio a sense of community. So we were actually all in the Patron Discord. We don't have an office. Patron lives within Discord. That's our virtual office. And so as the crisis was going down, we and my co-partners and the rest of the portfolio were in the Discord voice chat for probably 3 days, and everyone was hopping in, as real-time information was coming from Twitter, because all bar 3 of our portfolio companies were banking with SVB. So I think from a venture partner perspective, we're capital plus service, and the service there was, okay, we need to help our founders in the trenches figure this stuff out. So I think it was a really good lesson for VCs to just have a ton of empathy with what the founder experience is, and has, I think, set up a lot of funds to better support founders in the future when these type of unprecedented events happen. I think in terms of the environment now, if you're raising seed, the bar is just a lot higher than it was. Coming off the back of COVID, we're in this enormous bull run. Now it's a lot more, do you have a path to profitability, not just to like Series A, but also venture outcome. So we're looking at founders in our specific niche, which is broader gaming, to see, do you have a really strong ability to conserve cash, and do you have a plan to get to some type of monetization?
So does that suggest we need a different kind of founder with different skill sets?
I think it might be very beneficial for the ecosystem. We might see, some incredible startups being built now because you really have to lean into resilience, to perseverance, to being honest about whether you actually have product market fit. So I think it's going to be an interesting time, particularly at the early stage of the fundraising ecosystem, to back these types of new founders.
Joe, what would you say to that?
Yeah, I mean, I think a lot of the founders that we work with are pretty dynamic. I think it's about which muscle to exercise, for lack of a better term. It's more of a founder focus more on unit economics, focus more on having a story around why your product makes sense, why you're building something that people need, and how you're going to make money, how you're going to have your path to profitability, and how can you quantitatively defend that. And maybe the unit economics look a certain way today, but if you can tell a story around how those unit economics can scale and what you need to believe to be true for the unit economics to scale and for that to produce cash flow or profits, I think depending on your stage, I think it's that's something that I would embrace as an investor.
So when you say a path to profitability, what kind of timeline are we talking about? And we've had, clearly there have been issues about fake it till you make it. That era seems to be over, but what kind of discipline does that take now as opposed to a couple of years ago?
Yeah, so I mean, it depends on the stage of the company and the position, but I wouldn't assume that there is another round coming. So it kind of depends on what your cash position is today. So my starting point on that would be, how much runway do I have? And with that runway, what do I need to believe, or what needs to happen as a business for me to get to profitability within that time frame?
I just add on to that I think in the last cycle, you're at seed stage, you're raising money to burn to get you to the Series A, and that's just not the case anymore. In this current environment, we're looking at more sustainable growth and how you can actually truly build product market fit for the long run, not just to the Series A milestone.
And how does that play in the sector that you're focused on, gaming, consumer, Web3?
Yeah, well, I mean, games take a long time to get to market, but I think we are trying to back founders who we really believe in the long run will build a huge company. So our deal pace is a lot slower. We've only done 2 deals this year, but I think that's starting to pick up now. But again, it's looking for very special founders who are not necessarily building on the hype wave of AI. For us at Patreon, it's more about, do you believe that the next version of the internet is going to feel more like a game? And if you align with our thinking, then we could be a good partner.
So you've done 2 deals this year. How many did you do last year?
16.
Okay. So there's what you're up against. Joe, how many deals have you done this year?
4, with 1 or 2 at the finish line.
And how does that compare with last year?
We did about 8 last year.
Okay.
So we're on pace.
What you're seeing here is that the deal rate is down substantially. Now, that's because you're getting pickier, because the investors are getting more strict, or how does it, I mean, what's driving it this year?
Well, I think we're investing at pace. I think we are still riding the back of a technology paradigm shift in AI. And we see a lot of companies, particularly in the verticals that we focus on, which is legal tech, tax, software, fraud, risk, and compliance, and we're very focused on machine learning and natural language processing in those spaces. We're seeing a transformation in those markets, and we're seeing companies being built according to that transformation. And from our standpoint, with a fundamental shift like this, we feel like it's prudent to be deploying capital at pace. Okay.
Now, your customers were coming to you in a panic about a couple of months ago. What do they need now? What are these startups asking in terms of financial services? What do they really need in this environment?
Definitely. So it's 2 things. It's securely storing their capital, their venture dollars that they've worked so hard to raise. oftentimes in a different funding environment where now the goalposts have shifted. They were told to grow at all costs. Their boards, their investors gave them piles of cash, told them to spend it. Grow at all costs didn't just mean grow net revenue or gross profit. It was grow GTV, grow headcount, expand operations, even ahead of product market fit. That was in a zero interest rate environment. Now, in a different environment, it's we want cash flow positive businesses, we want AI. And that's a really tough transition for a lot of founders and operators out there. And so I just take a moment to acknowledge the amount of pain in seed through Series C funding environment for startup operators. They need to make really challenging decisions across the cost structure. And that has consequences not just for the startups and the founders, but for the employees at these businesses. And so in terms of what they're looking for today, it's securely storing their cash and knowing that they can sleep at night, that their funds are fully FDIC insured or SIPC insured, and that they have access to capital. And there are alternative sources of financing available to startups today outside of the equity markets, where founders don't need to take unnecessary dilution in a flat, high-rate environment. Venture debt is picking up. Revenue-based financing is becoming more and more ubiquitous across the startup ecosystem. And so what we encourage founders to do is to invest their cash in high-yield products like T-bills and money market funds that today are yielding north of 5% to extend the runway, maybe avoid an unnecessary layoff, and then look at alternative sources of financing beyond equity markets. Instead of taking that down round, perhaps you can raise a term loan or venture debt product, or you can tap into your future revenue streams to pull forward revenue-based financing and invest in growth or extend your runway today to get through cycle. And we are seeing glimmers of hope that the days are brighter ahead of us here in the equity markets. The IPO markets seem to be thawing out. The AI boom is bringing some venture funding back to the ecosystem. And so there are some positive tailwinds and indications that things will get better, and we're helping founders weather the storm to get there.
So how would you raise money now?
So today, we have two products, banking and lending. Within lending, it's RBF and venture debt. And so if I was to eat my own medicine, what we would do is we'd tap into our ecosystem of venture debt partners and would identify a term loan opportunity based on the fundamentals of the business, not based on hype and FOMO and who's on the cap table, but based on pure fundamentals, ARR, gross profit, and cash flow. And you can tap into this without incurring any incremental dilution to get through cycle.
Okay, last questions. What is the deal situation going to look like in the next 6 months?
Well, I think, as a VC, you're in the business of optimism. So I think at the early stage, we're optimistic that there's a new generation of founders who are going to build very big, sustainable companies. So I think it's just persevering, and it's a relationship business at the end of the day. So find a partner that shares the same worldview as you, who can be in it with you for the long run.
Yeah. I'll go back to the bifurcated comment. I think for later stage companies that don't have a path to profitability and growth is decelerating, this is going to be a tough time. They're going to have to figure out a way to re-accelerate growth, reinvent the business, pivot to something, launch a new product, and they're going to have to do it in a way that is lean and efficient from a unit economic standpoint. And I think, in the earlier stage with the companies that are building around generative AI, I think they're going to continue to find interest, and they're going to continue to find investment interest as long as they are building their companies along, with operational rigor and discipline for growth and profitability.
Okay, thanks very much. I think that's all the time we have for. So if you're raising money out there, good luck to you.
Thank you.